Hey everybody, it's Larry Berman here. It's early Friday morning, July 7th, before the non-farm payroll report comes out. So I haven't seen it yet, but it is the day of our member guest at our golf course. I've got my golf gear on. I'm heading out to the golf course after this. Hopefully the weather's good today. We got rained on in our practice round yesterday a little bit, but I shot a 70. Best round that I've ever scored at my Thornhill club. So pretty excited about today's event. I'm looking to get out of here. So let's dive into the chart rooms and see what we could see this week and what we learned from the markets. So as we often do, we take a look at the economic calendar. As you can see here, Friday, it's 6:30 in the morning here, and we have not yet seen the payroll report. Now, based on yesterday's combination of data, we saw the ADP employment report come in at a massive 497,000, where previous month wasn't really revised down much, and expectations were 2.25. The vast majority of this delta came from the hospitality and leisure sector, and so the joke was that 250,000 lifeguards were hired, as the summer gets going here, and the reality is somewhere like that. The seasonal moves are supposed to be smoothed out, but don't often get that in the data. So it can be lumpy. Getting into the employment situation report today, we had a massive number last month, big surprise to the upside. If you look at, someone did a survey and they looked at all the economist estimates and then what actually happened over the last year, and the economists have misjudged the economy by something like 2 million jobs. And for the most part, I think they're second jobs. For more and more people who are having trouble making ends meet in this, I would say, difficult economic environment for a lot of people. And so look for the unemployment rate to come down, average hourly earnings. This is the key area around inflation. So my expectation is we get a little improvement there, but not enough. And after this, if we look at, where the Fed's going to be at, that's going to be the key thing in terms of a rate hike. So let's kind of look a little bit deeper here, and I want to look into the Institute for Supply Management numbers. But if we take a quick peek at expectations, again, before the Fed for the July rate hike, we're now at 86%, with odds pushing towards a second rate hike being priced in. And as you can see, as we get into 2024 now, higher for longer is starting to get priced into the money market curve, but not yet into the equity markets. Institute for Supply Management used to be called National Association of Purchasing Managers. So the old ticker on Bloomberg here is NAPM PMI. So a number of years ago, they started a services survey. This is the manufacturing one. It goes back for decades. When this number historically drops below 50, you've got a manufacturing recession. And sometimes it's just an inventory correction mid-cycle, and other times it's more demand-led where the recessions fully play out. And you can see all the recessions here historically and how that ISM number dropped below 50. So, here we saw one in the mid 80s, no recession, saw a little dip here, mid to late 90s, no recession, mid 2000s, no recession, and so forth. Couple mid-cycle back here. It's not a guarantee that this goes into recession, but when you look at the yield curve and you see how much it's inverted, the manufacturing side of the economy is much smaller relative to the consumption side. And so when we look at the PMI services, it's kind of above 50 still, And it's not until all those people who are working and buying all those services start to lose their jobs. So it's a chicken and the egg game here, but we think that when you look at the weighted combination of PMI numbers and you look at what's happening globally, it's pretty clear the tightening cycle is starting to take hold. I've said for months and months and months now, this top forming process, it's a process. It's not an event. You don't wake up one morning and all of a sudden, boom, there's the top. Or do you? So let's have a look at the S&P 500 price behavior. All we'll know from the October lows, good rally. We were very bullish down here. We got concerned again up here and we started to recommend caution and hedging. Been doing that for months and months and months. And generally speaking, up until June, that's been a good idea because we did get a couple of pullbacks along the way. But June, really like a game changer. Market breadth, everything started to improve. We got up to the next level of resistance, which we're starting to see on the charts now. So those of you who study charts will know that this move up in June here, resistance, little pullback correction, we got the retest, kind of failed. And this week we've got what's called this island forming here. So you've got this island, you've got the test of resistance, and you've got your RSI peaking here with a lower high here. Bearish divergence, island. Again, when you get a bunch of information lining up, so what is the employment number going to do today? I don't know. By the time you see this Saturday, what I'm talking about here might sound silly. But if the employment number is hot, the Fed is going to move on rates. It's going to be very difficult for this market to keep going here. So that's kind of the message of the week here. But what's different now than through this whole period here is what's happening to longer interest rates, because ultimately our funding costs matter a lot. So what we had seen here during these other sell-offs, go back here again quickly, other sell-offs in terms of markets here, and here, you know, you had the bond market, bond yields start to push higher. Of course, here in March, we had the banking crisis that changed the dynamics. We had another move up here in May. Again, going back to the S&P in May, not much of a sell-off in there. And now we're seeing yields start to break out again. That's the 30-year. We look at the 10-year. Again, starting to move here. Again, relative. We look at the 5-year. Already close to those extremes from October. So you have the cost of money, especially in the front end, pushing up against the extremes we saw when equities were way, way lower. Something's not adding up here, folks. I think the equity markets got it wrong. Let me go quickly back to this, because what I didn't mention, and I want to talk about now, this orange squiggly here, this is earnings per share. And on this scale, I've got it in a log. And what that means is in percentage terms, that a move from 5 to 10 in terms of distance is the same as the move from 10 to 20, 20 to 40, 100 to 200. So earnings right here on a trailing basis, you can see that number 223.5. What happens historically when we get these recessions and NAPEM turns negative or ISM turns negative? We get earnings recessions, rinse and repeat over and over. So best case scenarios, earnings don't grow. Worst case scenario, earnings recess. The market is not priced for this, folks. So what's the outcome? You can play soft landing if you like. I'm not in that camp. The bond market's giving us a very different message. If we look at TLT, long end of the bond market, and we go back pre-COVID. So here's COVID. Obviously, interest rates shot lower significantly, flight to safety. Here's the Brexit extreme in terms of what happened to long interest rates. We think there's going to be a huge level of zone of resistance for yields getting lower. So I don't think we're going to go back to zero and ZERP anytime soon. But this sell-off here, and whatever it works out to be, the combination of QT and whatever the Fed has left in terms of tightening, can take TLT, that you can see is breaking a little bit here, down towards these extremes. Whether we go through it or not, folks, I don't know. Possible. But for the bears out there who want to play for the recession, this pullback against this area is going to be your opportunity to strap on a lot of duration. I've been trading duration for months and months and months. We lighten up out here. We buy into here. We're starting to buy again. I want to be fully loaded, cocked and loaded, as they say, ready to fire when this recession hits. Where is this rally likely going to take us in long bonds? Somewhere back into this range. So if on average we're net buying somewhere between 90 and 100 in terms of TLT, we think the profit on this trade is 20, 25, 30% in this range sometime 2024. Could take into 2025 before it fully plays out. But where are you going to make 25 or 30% in something that's not correlated with equities over the next year? So this is a really good trade setting up here. I think it's our bull trade of the week right here is thinking about long bonds and how do you get that into your protection, into your portfolio. So that's something to think about. And on the bear side, of course, going back to our S&P 500 here, looking at that island and that divergence. I've been saying caution for a while. June was not a good month for us, but folks, we're going to pull back very likely into this zone of support by September, October timeframe. And that's your next buying opportunity for stocks, I think. Right now, caution is the message. Have a great week, everyone. Wish me luck in my tournament. Go Leafs, go.